everyone. I am Nancy Naji.
I am Nancy Naji. I am Nancy Naji. I am Nancy Naji.
Welcome to our segment Hello Money. Today we'll be talking about the payday.
You have to be street smart. We all know this year. No grief for anybody is our 2024 tagline.
Good morning, everyone, and thank you all for joining us. I am Nancy Naji, and this is Moneyline with Nancy. Let's get started with what's in the news today. The Central Bank of Nigeria has revealed that the federal government has spent a total of $15.5 billion on debt servicing from 2019 to 2024. The federal government paid $588.33 million in 2019 between January and May. However, the payment increased significantly to $5.4 billion in 2020, $2.02 billion in 2021, $2.34 billion in 2022, $3.43 billion in 2023. Between January and May of this year, the federal government has paid $2.18 billion debt service. Fitch Ratings has actually mentioned and predicted that, Nigeria has got to be sustainable when it comes to debt. All right, moving ahead, the World Bank has announced a supervision mission next month in response to the underperformance of a $500 million loan aimed at improving Nigeria's electricity distribution sector, and in response to the persistent challenges and underwhelming progress of the Nigeria Distribution Sector Recovery Program. Still with the World Bank, it is revealed that it has disbursed a total of $45.5 million to the National Identity Management Commission, NIMC, under the Digital Identification for Development Program aimed at enrolling more Nigerians for the National Identification Number. This is in response to the recent concerns that the NIN database and other government agencies' databases are not secured as Nigerians' data are being purchased online. The EU ambassador to Nigeria and ECOWAS, Samuela Isopi, stated that Nigerian and Ethiopian business leaders, policymakers, and institutional stakeholders will meet to identify and explore investment opportunities along specific value chains during the 9th European Union Nigeria Business Forum, emphasizing that it will also facilitate trade, investment, and partnerships through networkings, discussions and policy shaping to promote economic cooperation between the EU and Nigeria, and also to stimulate sustainable growth for both parties. Still with the European Union, now the European Union Commission has confirmed its plans to invest 150 billion euros in trade and transport infrastructure across West Africa with a special focus on the Lagos-Abidjan corridor. The team lead of the EU delegation to Nigeria and ECOWAS, Celine Horst, disclosed that the effort is to decongest Lagos port and improve inland dry ports, which would significantly enhance trade between Nigeria and Benin. The National Bureau of Statistics has released its 2022 National Agriculture Sample Census Report, revealing that over 40 million households in Nigeria engage in agricultural activities. The report, launched in Abuja on Monday, identified crop cultivation as the most prevalent agricultural activity. The report also offers comprehensive overview of the sector strengths and patterns, which covers 767 local government areas and over 30,000 enumeration areas across Nigeria, excluding only 7 areas due to security concerns. This also reveals thriving agricultural sector. According to the Minister of Budget and Economic Planning, Atiku Bagudu, the extensive coverage achieved by the National Bureau of Statistics indicates that the security situation in Nigeria is not as dire as commonly perceived, with farming activities continuing to thrive in rural areas.
Calibrate our deliverance structure so that we support them to generate more return for what they are proud to do. By so doing, contributing to our national productivity, national output, national income. In fact, the biggest key to sustained economic growth is to ensure that those 40.2 million households are continuously supported so that year after year they can do better.
Chairman Senate Committee on Planning and Economic Development, Senator Abdullahi Yahya, and the Statistician General of the Federation, Adeyemi Adeniro, emphasized the significance of the data that it lies not only in numbers but also in the insights they provide to inform policy decisions that will enable the government to achieve food security through targeted interventions.
The major problem that we faced is the problem of connecting production with processing and industrial usage. And without that part of the production value chain, you cannot stimulate production. It's not an issue of just providing farmers with inputs, or providing farmers with water, or providing farmers with oil. That is important. But what is important is the kind of demand that is generated for their products. Because once there is a demand out there, people will do everything to come and invest so that they can raise productivity.
The data generated from these sensors is more critical than ever. From a statistical perspective, these results serve as a significant input for the ongoing rebasing of our national accounts, or the gross domestic product, as we know it. But it goes beyond mere numbers. It's not just about numbers. It is about empowerment. It is about evidence-based decision-making. By understanding the current state of agriculture, we can draft and craft precise policies and programs to tackle critical challenges such as food insecurity, promote sustainable agricultural practices, and elevate overall productivity. It will also assist in attracting much-needed private sector investments into the agricultural landscape. The data will equip investors with the confidence and knowledge that they require to make informed decisions regarding agricultural ventures in Nigeria.
The Special Advisor to the President on Economic Affairs, Dr. Tokbe Fashua, also highlighted the significance of the NBS report.
Urban agriculture, with a basket of tomatoes selling at 150,000 naira, we've got a problem. But urban agriculture can help. And that's also going to help us to begin to limit the kind of inflation that we're seeing. I'm working on initiatives that will not only solve the inflation we have immediately, but also begin to help us into the future with managing inflation.
time for Africa to engage in serious conversation aimed at finding answers for its problems.
My brothers and sisters, I firmly believe this mutually beneficial friendship will benefit from opportunities created by the African Economic Congress platform. And this is the reason we need to deepen democracy in Africa and empower citizens and civil society organizations.
The Nigerian Exchange Limited has fined 9 quoted companies 76.8 million naira for failure to file their audited financial statements after the regulatory due date and their inability to meet the regulatory requirements for the year-end 2022 and 2023 financials. Still with the market, but now over to the stockbrokers. The Chartered Institute of Stockbrokers has called on the Central Bank of Nigeria to adopt advanced technology throughout the bank recapitalization process to ensure efficiency and effectiveness. The institute recommended that the entire process from the office closing date to share allocation should not exceed 20 working days to ensure investors' funds are not inactive for extended periods. Now you need to listen to this. The National Agency for Food and Drug Administration and Control, NAFDAC, has alerted Nigerians about the illegal products alleged to be sold by a company named Babangida Agalawa General Enterprises. NAFDAC states that illegal marketing of medicines or counterfeit medicines pose a risk to public health. The President of Kenya, Dr. William Ruto, has applauded the youth following the peaceful protests against proposed finance bill that aims to raise an extra $2.7 billion through additional taxes by the International Monetary Fund. The President expressed government's willingness to engage the youth. All right, that's it for what's in the news right now. Let's quickly take a break, shall we? And when we come back, I'll be running you through the markets, just a quick check on how the markets are faring this morning. Don't forget to connect with us on all our social media platforms. The handles will be on the screen shortly. Let's take a moment. All right, welcome back to the program. Let's quickly take you through the numbers. As you can see right now on the screen, 99,304.12 points. The market closed on Monday. Please, can the audio be muted? I can see here the MCR. Okay, 0.44% there for the market. So we saw a bearish close yesterday. The downtrend was primarily driven by sell-offs in FBNH. I'm talking about FBNH now. Femi Otedola, who is one of Nigeria's billionaires, has consolidated his stake in FBNH to about 11.64%. All right, these were the price gainers yesterday. So you can see that John Holt, VFD Group, Thomas Wyatt, as well as Transcorp Hotels. Let's move over to the losers very quickly. Do we have that? So you can actually see the losers right here. International Breweries, Oando, Better Glass, and Dark Communications yesterday lost 8.7%. The stock trading at 52 kobo. All right, let's move over to Naira rates. Of course, this is the NAFEM rates, the source from the central bank. The Naira to the dollar at 1,488.45. This was at yesterday from the central bank, of course. If you go on the website now, this is what you're going to see. 1 pound is going for 1,889 US dollars. Euro is going for 1,597 Naira 70 kobo. Let's move over to the money markets now, where we saw yesterday the OBB, that's talking about the open buyback and the overnight rates dipping. The open buyback rate was at 23.5%, while overnight rate closed at 24.03%. For the Treasury bills markets, we saw it in a very subdued mode on Monday, though tilted to the bulls with interest seen across the board. Investors or even market watchers are expecting a bullish mood today. Let's see how that will pan out. But for the bond market, unlike the Treasury bills market, the bond market was relatively subdued as participants on Monday awaited the outcome of the bond auction. While in the Eurobond market, it was bearish sentiment that was experienced yesterday. The market continued to price on the possibility of no rate cuts this year. All right, what you can see on the screen right now, talking about other African markets, the Nairobi Stock Exchange in Kenya, top 20 stocks, that's the index as at the last time we checked, 19 basis points down. EGX 30, 26,801. Now let's move over to the rest. Other African markets, 36 basis point downside for the South African market, as you can see right there. The Ghana Stock Exchange down 0.24%. That was as at yesterday. I did tell you also yesterday that the Ghana Stock Exchange has agreed with its bondholders. You know that it's borrowing $3 billion from the IMF to be able to stabilize its economy. Now, these are Dow futures this morning as... let me just quickly check. Okay, as you can see, you're seeing green numbers across our board. So Dow futures are climbing, obviously, from the S&P 500 to the tech-heavy NASDAQ to Dow futures. That's Dow Jones Industrial Average, DJIA. All right, let's move over to Europe and see what's happening there this morning. European stocks were a bit lower, so you're seeing reddish sentiments, as it were, from the CAC 40 in Paris down earlier this morning, 0.60%, while in Spain, IBEX 35 was also lower, but just a bit slightly. Let's move over to other European markets. The German DAX down by 1.1%. FTSE 100 in London up slightly by about 8 basis points. It's just a few days to the elections there, and we will definitely see what would happen. Let's move over to Asia very quickly, where the Nikkei 225 was up 0.83%, but we saw China CSI 300 hitting a 4-month low today, even as some Asian markets gained. So from what you're seeing right here on the wall, Australia's ASX 200 up by about 1.3%. 6%. The Nikkei 225 up also, while Chinese Shanghai, okay, that's down 0.41%. Okay, Hang Seng of Hong Kong was up. Kospi of South Korea up also. All right, but also getting news from South Korea earlier today, consumer confidence in the country climbed in June to about 100.9 points from about 98.4 points in May. All right, we're looking at commodities now. Gold, as at this morning, the last time we updated, gold was trading down about 19 basis points at 2,326.40 dollars per ounce. That's 1 ounce there for gold. I told you yesterday that I think 32 ounces of gold make 1 kilogram. That is 32 ounces is equals to 1 kilogram of gold. Silver is doing $29 there for an ounce of gold too. Steel is doing 3,365 Chinese yuan for a ton, while iron ore is going for $106.55 a ton. Let's move over to other commodities. Brent crude is trading down, as at the last time we checked, 4 basis points, 85 US dollars a barrel of oil there. Coal is doing $131.90 a ton, down 0.45%. All right. Agricultural commodities. Palm oil is doing 3,900 there. Wheat at 553 US dollars a bushel, while cocoa is doing 7,888 US dollars there. Sugar is $19.32. All right. That's it for other markets. Let's quickly take a break. And when we return, it will be time for us to get into our conversation proper. We will be talking about banks' capital raising, the impact on the Nigerian stock market as well as investors. We've seen a rush for raising capital from the banks since the announcement of the recapitalization guidelines in March by the Central Bank of Nigeria. We'll be giving you more details when we return. This is also one interview you need to listen to in case you have some cash and you want to invest. So you just need to listen into this next segment, which is our interview. We'll be right back. The Central Bank of Nigeria announced in March this year new capital requirements for banks. The guidelines require that international banks must raise their capital base to 500 billion naira, national banks to 200 billion, and regional banks to 50 billion naira in response to the mandate of the CBN. The Securities and Exchange Commission, that's SEC, released its guidelines, comprehensive framework. Of course, the SEC is the press regulator. It released comprehensive framework providing detailed guidelines for banks, holding companies, as well as market participants on filing applications for capital raises and mergers and acquisitions. Now, since this announcement, we've seen some top Nigerian banks eyeing the international and local capital markets to raise fresh capital in a bid to meet the recapitalization exercise within the 2-year window till March of 2026. The CBN proposed various ways for banks to raise capital, including issuing new shares, mergers and acquisitions, or even adjusting their license categories. Presently, the NGX stock market segment is experiencing a surge in activity as listed commercial banks provide investors with a chance to own a portion of the pie and for some to raise their stake. How will this impact Nigeria's capital market? Is the capital market deep enough for these capital raisings? Is the Nigerian economy healthy enough now to finance about $5 billion in new capital for banks? My guest joins me now to discuss this topic. He's Mr. Tajuddin Olayinka. He is the Chief Executive Officer at Wyoming Capital and Partners. Good morning, Mr. Olayinka, and thank you for joining us.
Good morning, Nancy. It's my pleasure.
Okay, let's get started. The banking sector is a bit excited now. Okay. The banking sector is a bit excited now and abuzz with a rush for capital. Is the stock market as excited and, glad with this, with this development? What's the level of excitement for the capital market?
Okay. The excitement will always be there, but are they totally excited? Maybe that is the word I should use. Are they totally excited? Because economy is going through a challenging time, and for that reason, it is possible that some investors will not be able to actually participate, because of low purchasing power and all those stuff. And those investors already know themselves that yes, this thing is coming. Even when they are doing right, will I be able to take my rights? What options are available to me that I can still participate? All sorts of questions are being asked. But of course, there are traditional investors, and I'm sure the banks are actually targeting these traditional investors. Quite unlike what we had in 2004, 2005, when this bank came up with this capitalizing exercise. This time around, we have more asset management companies operating in the capital market space. Actually, creating more active activities in the market. So, for that reason, I've said that yes, maybe the retail investors may be quite challenged this time. But institutional investors, such as asset management company, the PFAs, all those categories of investors and high net worth individuals will still be able to either take their right or take or participate in new offer for subscription. So yes, excitement is there, but are they totally excited? That's the question we should be looking at. We should try to answer. Not many of them will be able to exercise their right, and for that reason, we want to see what windows are open to those of them who may not either be able to participate in the public offering, or who may not be able to also take their rights. But again, if you look at what is going on now, the approach this time around, because of a digital status of the market itself, the offering itself, we are likely to see some, we'd like to see participation from young generation of Nigerians, young generation of investors. Those who were not part of it in the past may also be part of it now. Just a little shift from what we saw in the past, where even the shoemaker was able to participate because the economy had a boom, and there was some kind of credit to the market, to investors. So some of them were able to participate then, but this time around there's no credit. But of course, because of the digitalization of the offering process, we may see new generation of investors who are actually tech savvy and who want to benefit from this market. I can tell you clearly, only institutional investors should be able to do so much this time around. And of course, we are expecting foreign portfolio investors to also participate. That's on one part. That's on one part. But of course, if you also look at the interest rate, the yield environment in the fixed income space, it's also a challenge on the pricing of this equity. The share that be offered to the market by some of these banks. But of course, we have seen some kind of resilience in the equity market. But ordinarily, with that kind of high yield environment, we expect that equity prices should have gone down below the level. In fact, index should have gone down below the level we have it. But because of the presence of this category of investors that I mentioned earlier, the asset management companies, high net worth individuals are more, PFAs also playing in that space. We seem to be having, a more resilient market. So for that reason, I think we will still have some reasonable level of participation.
Okay, you said a lot, Mr. Lankan. Let me try to unpack that. When you talked about the level of excitement earlier, are you saying that the level of excitement we saw perhaps in 2005 during the banking consolidation, was it more than we're seeing now? Let's get that sorted first. Okay.
It was more then than what we are seeing now, because then, investors had access to credit. Investors were able to, in fact, economy was more robust than what we have now. So, there were several windows open even to new investors who are not part of it. For that time, I remember going on Broad Street in my red jacket, and a shoemaker called me. He said that your guy. You understand that there was this public offer in the market. I should come and advise him. That's what a shoemaker. But I don't think a shoemaker will come near this market at this time with the kind of low purchasing power. So what I'm saying is that what has changed now, that we may have young generation of investors, all those young guys, young bankers, people who didn't participate then because of the fact that we use more. We didn't use digital method, but now that we are using, yes, we are now using technology. I'd like to see a generation of investors coming in, this time around.
Okay, but earlier on, you also did mention that institutional investors, as well as foreign investors, will be the one that perhaps will gain from this recapitalization exercise or this capital raising from the market. Where does it leave retail investors? Because there was a time, I think in 2022, there was a time that foreign investors dominated the market. After some time, retail investors usurped that position, and it went back again to foreign investors. Can you give me a sense of the composition of our markets now? Then I can ask the second question I wanted to ask, because it will lead to that.
Nancy, the investor that we have, the reason we have resilient in the market so far is just because we have more institutional investors playing the market, local investors who are institutional, not retail. Okay. Retail are not doing much. Retail are not doing much. Okay. But of course, some of them will still be able to do something. Don't forget, we have low purchasing power. In fact, the economy itself has a low purchasing power. So that's the reason.
Okay, so this means now that this capital raising that the banks are doing right now, the foreign investors as well as institutional investors have more to gain than the retail investors.
Exactly.
Okay. The aspect of technology that you brought in, bringing in the new generation investors, young people now, because even on their phones, they can buy shares and all of that. Will that component be also a contributor? Would we see, because of the market is awash with offerings now, be it rights issue, public offer, or even private placement, with technology now contribute to having more retail investors and new investors?
Yeah, the technology, that's what I said, technology will now be able to replace the traditional retail investor that we will not be having this time around. The technology will bring in this generation of investors to participate, and for that reason, we still have just maybe I'll call them a new bride. These young generation of investors who are tech savvy, who like to see anything on technology, and of course for that reason they could be attracted, and so we will still have them participate in that space. And so those will represent what we call retail investors, but not the traditional ones we used to see, not those shoemakers, not those mechanics who want to participate in public offering. This time around, we are likely to see more sophisticated younger generation, retail investors.
What will it take to bring those categories of people into the market? Like you mentioned that during the consolidation days with your red jacket, a shoemaker approached you. What will it take to bring in those kind of people? Is it about low purchasing power now, or even those categories of people do not have the information? Unlike those days, it was really, information was everywhere. Everybody wanted to invest in stock market. They were giving margin loans and all of that. That is not existent anymore now. But what will it take to bring in this category of people? Is it just about low purchasing power, or the information is not really there to those categories of people? They don't understand it.
I believe they will also understand it. What is happening is that, in fact, the information dissemination at this time is even is even broader compared to what we had in the past. Of course, I mean, there will be a lot of advertisements, jingles, and all those things on TV and radio, and so that will also, attract them. But what I'm saying is that, do they have can they make savings at this time when they are unable to feed? Can they make reasonable savings when they have not, they're not able to pay their students' school fees? Can they make reasonable savings when what they hear is just to take care of them, just for one day? So, but I know that there are still some this category of investors who will still struggle. They will struggle to be part of it, but not many of them will be part of it, and that's why I think. Some of these banks are also trying to do right issues so that even if you cannot participate directly, you cannot do you cannot participate in the new offering. Take your right. If you can't take your right, which is coming at a discount, if you can't take your right, you can also sell that right. Sell part of it and use the proceeds to take part. You can do half. You can do part of it by selling part of the right to take care of the remaining rights. So we'll see what the judgment is. Advice from brokers and those discipline agents who will be marketing this offer.
Let's dwell a little bit more on how inflation is impacting the sale of perhaps these rights issues and public offer. You've talked about it a bit in terms of purchasing power. How much of an impact will this high inflationary environment in Nigeria contribute to this recent banks capital raisings that we're seeing left, right, and center?
Of course, we have seen that reflect in interest rates. Because of the fact that we have high inflation, interest rate is up. Ideally, this is not the time for anybody to come to the market to raise money when interest rate is high. What that means that you are going to raise money at a higher cost of capital. And no board of a company, no board of a bank will want to approve that. They want to raise money at a lower cost of capital, lower cost of equity. But cost of debt is high. So once cost of debt is high, there is no way you can push down the cost of equity. But because market is resilient, we still have a bit of accommodation for them. For instance, a stock that is, I mean, maybe let's look at Fidelity is doing one now. Let's assume that if market is right for them, maybe ideally they should be doing it at maybe 15 naira per share. But now they are doing it at 9 naira or 10 naira. So when you look at that, that is the impact of inflation on what they are doing, because of the fact that the cost of debt is high. We are in the high interest rate environment, and for that reason, it is not likely that they can issue equity at a more higher price. So what they are doing is that most of them are issuing equity at a lower PE ratio, and so this is not something that is good for the market. But of course, they don't have any choice. More so also that they are restricted to the kind of capital they can raise. For instance, it can only be by way of share capital. That qualification can only be share capital and share premium, which means that they have to raise so many shares to be able to meet that requirement. Unlike when they had the opportunity to increase their reserve, but now this time around they are issuing more shares. So it's going to create a lot of dilution, for shareholders. So they have to demonstrate that yes, it's true that they are likely to be any dilution, but this new capitalism will bring something new to the table for existing investors and for those who come in newly to be part of the market, so that any dilution will be subdued. So these are things that these banks we need to demonstrate, and for that reason, maybe we'll see more participation once they can demonstrate that, because no shareholder want to suffer any dilution. And so, if you are issuing too many shares, and those which means that before now you used to do any per share of 3 naira, and after issuing this one, you're not going to be doing 2 naira 50 kobo. That's not good enough. So you have to demonstrate that you can go beyond, you can go above that 3 naira per share, maybe to 4 naira. So if you can demonstrate that, of course, irrespective of what is going on in the fixed income space or what is going on in the economy, you still see some investors who participate and say that there is future for this company. You must demonstrate that you have a very strong earning power.
This rush at this time, is the market also concerned about the timing in terms of, there's a 2-year window from when the central bank announced this in March till March of 2026, so 2-year window. How concerned is the market with the rush at this time? How calculated is the risk? Because I'm also taking a look at it that banks are rushing it to the market at this time. Will the market be a bit fatigued? Why don't we see a kind of sequencing? Because every bank is coming in at the same time. We are hoping that the economy gets better, because the economy is not doing well enough. The economy is not healthy now to perhaps give you that kind of capital. You will sweat blood, sweat, and tears to get that kind of capital. So will the market be a bit fatigued? Why not for banks to perhaps wait a while? Is that in any way kind of calculation? Or I'm just thinking on my own. I don't know, but I'm thinking so.
I think the banks themselves must have considered the fact that delay could be dangerous. If you do not want to go through consolidation, don't want to go through mandates of consolidation, or you don't want to be acquired, or you don't want to downgrade your license status. So you need to act fast and see what the market has in stock for you. I believe before now, most of them will have had some series of meetings with professional parties, to see what the market has in stock for them. But I think for those of them that are international, who need to raise as much as 500 billion, or who need to push their market, their capital, capital qualification to 500 billion, they need to really act fast. Actually, I thought before now, CBN was going to be a bit liberal, to some extent. Before you see that before CBN came up with this new capital requirement, they made sure that all the banks have submitted their accounts to CBN for full year 2023. So banks that were probably, in fact, they knew the status of all those banks. They knew that yes, this is their status. This is what they represent, and that's why they said, okay, we won't consider your capital reserve or your any form of reserve to be part of this new capital requirement. So CBN understand that if CBN had given them that latitude to use their dividend they paid for 2023 account to be part of this capitalism, it would have been good for some of the banks. I thought they were going to do that for them, so that for instance, all those big banks will have used the dividend they paid this year, which was for 2023 account, to satisfy the right for those existing shareholders. In fact, in that case, all existing shareholders will be able to take their right, because it will be done through a trust arrangement. I thought that was going to happen, but CBN beat all the banks to that. And so, what some of the banks are now saying is just to educate some of these investors. Okay, we just paid you, dividend, full year dividend. We just paid you dividend for this for 2023. You can use this dividend to buy your right, or to even be part of the subscription, and you can add it to augment what you have elsewhere, so that you'll be able to be part of this. But the greater thing that will make this offer, all these offers successful, is for the banks to come to the open to say, yes, this new capital, even though we are using more shares than we should ideally do, these new shares, this new capital that we are raising will bring new things to the table. Not that it's going to create a very serious earnings dilution. Once that message can be passed to the outside world, to all potential investors, of course, we'll see participation from all categories of investors. What investors like to see is this new capital bringing something to the table? Or is it just want to buy technology, want to invest in this, want to invest in that? What is that thing bringing to the table? Is it going to create any dilution? If it's not going to create any dilution, you will see support. So that's why I look at it.
Now, if this move, according to the CBN, is to fortify the banking sector, won't the market be also facing a risk of lopsidedness? I hope you understand what I mean, because this would help fortify the banking sector. The banking sector is a major component of the stock market as it is. The stock market is already heavy weighted on the banks. So will this additional strength, wouldn't it cause more lopsidedness for the stock market?
Well, of course, it should. It should. But what will improve that will be when, because we don't forget also that we have more companies also waiting to test the market.
Exactly.
Except that this bank coming now may also disturb them. But if we have a successful outing between now and say end of the year, we would like to see more companies come to the market to raise money, and those who are already in the market also raising new money, to be able to improve their capacity to deploy resources. So what will reduce that excess weight from the banking sector is for more companies to be listed on the exchange, and I think the exchange itself is driving towards that. I believe we will have that improvement once we have improvement in the economy. The economy is what is driving most of them away at this time. But of course, they will have no choice than to also come to the market. Why government continues to struggle on how best to position the economy. I believe we will overcome all these challenges.
Can the banks raise all the capital from the stock market? All the banks that have announced, from Wema, Fidelity, Access Holdings, FCMB, GTCO, UBA, Zenith, can the banks raise all the capital they need for the recap from the stock market?
Let's look at it this way.
It's a yes or no question, Mr. Lainka. I don't want to look at it anyway.
It's because there are three critical ways that they can raise this money, apart from issuing new shares, either by way of right or by way of over for subscription, also by way of placing. I don't want to call it private placement.
Private placement.
Some have called it private placement. It's actually placing. No public company can do private placement. What they can do is placing, to place that share before a particular investor, maybe one or two investors who can bring something on board to improve the luck of that bank. So they can do placing. So I expect some of these banks to follow that route of placing as against doing public offer or doing right issue. They may do combination of right, public offer, and placing.
So does that answer the question of if the banks can raise all the capital from the stock market?
Yes, it answers, because they may need to take in new investors that are not part of the market already. That's why I said they may do placing.
Placing, yes.
They can do placing. So placing will now bring in these sophisticated investors, somebody who want to who want to have a controlling interest in the bank, or who want to have at least 21% ownership of the bank. And it's not part of the system already. They can bring such people in, and that will also be new category of investors in the market. There are a lot of them that they do through placing, and of course, if they cannot meet it through that agreement, they can also maybe as they approach the final lap of the exercise, they can actually go through merger or consolidation.
Will the banks, do you think if the banks will meet the recapitalization process? Do you think that the banks can meet the recapitalization deadline with their processes so far of seeking more funds from the market?
They will meet it. I've given you the different route they can take. If they are going to, if you can do it whether through placing or merger. In fact, the last thing there is for you to go for merger. And once you can do merger, and so a successful merger, you are there. What is that one of you or two of you will lose to identity, and you create a new identity, just like you have in Sterling Bank.
Are there risks associated with the rush for capital at the same time? Everybody
Of course,
coming, yes.
there's always risk.
Yeah, because we're
There's
always
always risk.
talking of the good side. How about the bad side of it?
There's always risk that you may not be able to get as much as you want. That's why I said, even if you don't get as much as you want now, you still have opportunity to come back later, especially if you are going to pay dividend in 2024, your 2024 account. If you do so much that you have improved a lot of your bank in terms of earnings, and then you can use those dividends to also, and in that way, what you just need to do is to come up with what I would call not a right issue, more like a mandatory right issue, whereby all shareholders exercise their right through instead of paying dividend cash, they use that dividend to exercise that right for them, and they can do that one through a trustee. So it's going to be, I believe, by 2024 December, most of them will know whether they can actually pay dividend that is reasonable, that will make them to actually meet that requirement.
Can you enumerate some banks that have offers now, perhaps for the audience, those that are interested? What are the offers on ground now? I know Fidelity just brought out it. Wema Bank, I think, started this. I think Wema Bank, is it 40 billion in some kind of transaction, if I'm not mistaken? So can you just run through some offers that are on ground, and what are the opportunities for new investors?
I know Fidelity is, in fact, both Fidelity and Wema, they are offering. It's not right to say that they actually rush to the market. They were doing something like this. They were preparing for capital raising, not to this size. They were preparing for capital raising before now. So they wanted to shore up their capital for one reason or the other. And so they were already preparing for that before CBN came up with this new guidelines. So some of them were ahead of the guidelines. And so when the guidelines came, what they just needed to do is to increase the size and change the momentum. So that's what is happening in the case of Fidelity. I think Fidelity and Wema, but these are public companies. It is also possible that some of these banks that have holding companies, for instance, a bank is having holding company structure. The bank itself is not public; it's a private company. If the holding company believe that they can source money outside without coming to the market, some of them may be doing it through the bank directly as against the holding company coming to the market, because only the holding company can come to raise that money for them, being a public company, except they want to also make the bank itself to also be a public company. So for that reason, there might be some capital raising, like private placement, going underneath that are not part of that are not known to the public. For now, if they are done through private placement, it's different from placing. No public company can do private placement. What they can do is placing. But the banks that are subsidiary of this holding company that are still private company, social bank limited, they can also within that confine be able to do private placement and raise money, while the holding company can come later and raise money to the public. So that may be going on that way. A lot of strategy, will be going on, in the banking circle to see how best they can achieve this requirement. But I believe the two we still have, to the best of my knowledge, are these two public institutions.
Okay, so you've talked about Wema and Fidelity.
Fidelity, yes.
Which other banks have offers? Are you selling, which ones are you marketing to your?
Well, we are marketing, like I said, unless they are public companies, top brokers will market them. But like I said, there could be some that are doing it through private placement, maybe through their subsidiaries, not through the public, not through the one that is not to the public. And so until they come to the market, we will not know whether. But I know that a lot of meetings are going on now. Professional parties, having meetings with all these banks. A lot of them, none of them. In fact, some of them are even some of them that are private, also thinking of coming to the market, to raise money. So there is a lot of meetings going on with professional parties. And at this time, it's difficult for me to say these are just the category of banks that we'll see in the next few days. But I can tell that a lot of meetings are going on at the moment.
Let's talk as we end the show. Let's talk about the chairman of FBN Holdings. FBN, that's Femi Otedola, acquiring additional 4.63% stake in the company, taking his stake to about 11.64%. A memo was written that a communication was given to the exchange on this. How is the market taking this news?
Well, market is used to that.
And we saw that the FBN, sorry to cut you short, the share price yesterday sold off. It ended in a bearish position.
But it is also because he's doing it to negotiate. He doesn't want the share price to move so that it does not affect what they plan to do in future. And of course, he doesn't want to disrupt the market. He doesn't want a situation where it will put pressure on the share price. So there must be a particular investor who was willing to actually over his own to him, and that was why he could get it, to that arrangement. But Otedola is looking beyond just increasing his share. He knows that they might be doing right, and for him to be able to benefit more from right, he needs to increase his shareholding in the company to be able to benefit from that they'll be doing in the next few weeks or the next few months. So I think he's trying to be ahead of what the market or what the bank will do. That's what I suspect is happening there.
Okay. And I think the holdco is set to, get about 300 billion naira in fresh capital. So let's see how that pans out. Thank you very much, Mr. Laika, for joining me this morning. I wish you a lovely day.
Thank you very much. It's my pleasure.
All right, I've been speaking with Mr. Tajuddin Olayinka, who is the Chief Executive Officer at Wyoming Capital and Partners. We've been talking about fundraising, that's capital raisings by banks from the stock market. So if you're a savvy investor, you need to, take in this opportunity. I'll see you all again tomorrow, God willing. I am Nancy Naji. Be the best you can be and be the change that you want to see. Bye now. Hello everyone, I am Nancy Naji, a financial journalist, the anchor of Moneyline with Nancy on AIT. Today I'll be talking about smart savings tips for students.
Great Nigerian student. Great. Very good.
So attention students, hold your ears so that you can say goodbye to financial struggles. Number one, calculate your income. Know how much money is coming in so that you can set a realistic budget. Number two, track your spending. Monitor monthly expenses to identify areas for potential savings. Number three, set financial goals for yourself. Establish short and long-term goals to guide your budgeting efforts. Number four, compare your income and expenses. Ensure that your income covers your essential needs, adjusting spending accordingly. Number five, buy second-hand items if you can. And if I know you can, so save money by purchasing used items, especially books that are expensive items for you while in school. Number six, cook your meals. Cut costs by limiting dining out. Cooking at home is not only economical, but promotes self-care. I'll see you all in the next video. Don't forget to subscribe to our YouTube channel, Moneyline with Nancy. Join us on our program on AIT too. Hello everyone, I am Nancy Naji, financial journalist. I'll be talking about common money mistakes to avoid. And number one, ignoring financial challenges. Tough times, of course, bring discouragement, but don't let it lead you to overlooking financial issues. Make 2024 the year for financial organization. Address and understand your financial concerns. Seek advice from professionals to gain insights and clarity. Number two, avoid over concentration in investments. Don't put your investments in one basket. Placing all your financial resources in a single investment or sector poses risk of financial losses. Experts advise diversifying your portfolio across various assets like stocks, bonds, real estate, and more for better risk management. Number three, neglecting an emergency fund. The lessons we learned in 2020 from the COVID-19 pandemic emphasize the necessity of an emergency fund. It serves as a crucial safety net for unexpected events like job loss or unforeseen medical expenses. Even starting with small contributions can lay the foundation for this essential financial cushion. Number four, open communication. about family finances. Discussing money matters within the family, especially between spouses, is very vital. Understanding each other's approach to money and responses to financial situations foster clarity. So if your husband is the prudent type that knows about investment, he can handle issues about money. If your wife is the same, she can handle issues about money. But joint discussions enable better family financial decisions, including involving grown children, establishing a clear understanding of the family's financial standing. I'll see you all again in the next video. I hope you've learned common money mistakes to avoid in 2024. I'll see you all again. Don't forget to subscribe to our YouTube channel, Moneyline with Nancy TV.
Hello everyone, I am Nancy Naji, the anchor of Moneyline with Nancy on AIT. Today I will be talking about January federal government savings bonds. The Debt Management Office has introduced 2 new savings bonds for subscription at 1,000 naira per unit. These are the initial offers for 2024, with one being a 2-year bond set to mature on January 17, 2026 at an interest rate of 11.033% per annum. The other is a 3-year bond maturing on January 17, 2027 with an interest rate of 12.033% per annum. Both bonds are open for subscription. They've been opened from Monday, January 8th, and they will last till Friday, January 12th, with a settlement on January 17th and coupon payment on April 17th, July 17th, October 17th, and January 17th. Investors can subscribe starting from a minimum of 5,000 naira and in multiples of 1,000 naira thereafter, with a maximum subscription of 50 million naira. Interest is paid quarterly and the principal amount is repaid in full upon maturity. These savings bonds, like other federal government securities, are supported by the full faith and credit of the federal government and secured against Nigeria's general assets. What are you waiting for? As little as 5,000 naira, you can invest. Check out your licensed bank or your stockbroker. I'll see you in the next video.